Welcome to the Berkeley Center for Law and Technology's Advanced Life Sciences Institute series. And I want to welcome you specifically to today's program, Royalty Finance Structures and Trends. My name's Allison Schmidt. I'm the director of the Life Sciences Law and Policy Center here at the Berkeley Center for Law and Technology, and I'm the moderator for today's program. We're all very grateful to the Life Sciences Law and Policy Center for its support of this program today. It's my pleasure to introduce our expert speakers, who they wrote a terrific article that it's part of our CLE materials for this program that I encourage you all to read if you're interested in this topic. So my pleasure to welcome Todd Tratner and Ryan Murr to the program today. Todd and Ryan are both partners at Gibson Dunn. They're both members of the corporate department. Todd's practice focuses on IP transactions in the life sciences industry. Todd has a wide range of clients, really, both public and private companies, investors, and academic institutions. And he's an expert not only in the royalty finance area, which is what we're going to be talking about today, but also in M&A, licensing and collaborations, joint ventures, R&D financing, manufacturing, and supply agreements. Outside of his work at Gibson Dunn, Todd is very active in representing numerous nonprofit entities, and he's very tied into the Berkeley law community as well, serving on the board of directors for the Berkeley Law Foundation. Ryan is currently the co-chair of Gibson Dunn's Life Sciences Practice Group, and he's co-partner in charge in the firm's San Francisco office. Ryan is nationally ranked and a leading practitioner in the life sciences space, advising a wide range of companies and investors across a range of transaction areas. So Ryan's been doing this for over 25 years, working with both public and private life sciences companies and investors in connection with both securities offerings and business combination transactions. So with that, I think we can go ahead and turn over. So this is part one of a three-part series that the Berkeley Center for Law and Technology is hosting. So today, Ryan and Todd are really our experts in this area, and they're going to walk us through structures, trends, really get us, up to speed on the fundamentals, but also we're going to spend some time exploring practice tips and tricks in this area, really helping you think strategically about how to use these types of financing arrangements for your company. So part two of this proceeding, Jinhee Kim is going to be walking us through synthetic royalty financings and the UCC. And then in part three of this program, Jeff Krause will be walking us through risks of recharacterizing a true sale in the context of synthetic royalty financings. So with that, I'm going to turn us over to Todd and Ryan.
Hey everyone, thanks for joining us. Delighted to have you with us, and thanks Allison for hosting. Just a quick overview here, sort of the table of contents on the screen. We'll do a brief overview of royalty finance, talk about different types of transactions. Todd will do a bit of a deep dive into drafting considerations, and then that sort of sets us up nicely for parts two and parts three of this. But first, just a little bit of a sort of macro view of why we're talking about this and why so many people are interested in the topic. And really, this can be captured in sort of two visuals here that are on the screen. The top is a graph of the XBI, the S&P Biotech Index. And this is starting from January 1 of 2021. So this is around the COVID peak of the biotech bubble. And you can see how the XBI has performed up through yesterday. It's down 48% during that time. The S&P, of course, is up significantly. And the thing about the XBI is it includes commercial stage companies, which have fared much better than development stage companies. A lot of development stage companies that have had no clinical setbacks or other bad news, they're down 80% or more. And then the second graph on the screen shows the total number of biotech IPO issuances since 2014. And from 2014 through 2021, taking that average against the average from 22 through 25, you can see that there's been an 80% reduction in the number of IPOs going out with a very slow start to 2025. Usually Q1 right after the JP Morgan Healthcare Conference is a busy time. And so what this is showing is it is an inhospitable environment for raising capital in the form of equity. And really that's driving a lot of issuers to look at non-dilutive financing options. So
And
in looking at,
Ryan,
yeah,
Ryan, just to interject on that note,
yeah.
we've seen quite a number of biotechs, development stage biotechs, right, valued at their capital values less than actually their cash on hand, right?
Oh, there are well over 100 companies that are valued at a discount to their implied cash value. Exactly right.
Yep.
They're net cash.
Yep.
Yeah, absolutely right. So, in looking at financing options, this is sort of one way that we conceive of it, where you have sort of the entity level on the x-axis and the product level financing on the y-axis, and sort of thinking about it from a risk return profile versus relative to the level of investment. So, over on the left side of the x-axis, you've got equity-like returns, and that would be common stock. Moving over to something on the risk return profile that's debt-like, you've got secured loans, and in between you would have something like a convert. At the product level, if you do it, if you're financing not the whole company, but just individual products, you have royalty financings. We'll talk about that in a minute. You've got a capped royalty that has sort of an in-between return for the investor. And then over on the far right-hand side, you've got a royalty-backed loan, and that would be a loan that is non-recourse or limited to the royalties arising or product sales arising from a particular product. So it is more secure from the financing party's perspective, riskier from the borrower's perspective, but the recourse is limited to just the product. And then in between, you have sort of this basket type deals. So looking at this matrix and sort of where we're at right now, thinking back to the last slide, most companies are looking at the common stock and convertible debt as being too dilutive. At the same time, they're looking at secured loans and convertible debt as too risky, given the obligation to pay or the need to refinance. And so really that leaves sort of this top bucket here of product level financing opportunities that are probably the most attractive in the current environment. So with that in mind, in terms of product level financing, here are sort of the three big buckets of options as we think about them. And then this is a jumping off point for talking about them. The first is if a company has a royalty bearing out license, then there's an opportunity for that company to monetize the future cash flows arising from that license. That's a royalty monetization. Those structures can be flexible in terms of how you arrange them with caps and tails and things like that. We'll talk about that in a bit. Next, if a company has its own clinical stage program, one that's not approved, one that's not partnered, but is simply in the clinic, there may be an opportunity to do a clinical funding arrangement. These are a form of a synthetic royalty. The finance provider here is taking R&D risk, clinical risk, and given that they'll typically be focused really in late stage assets that have been at least partially de-risked through a phase 2 proof of concept readout, and they're really underwriting the risk of a pivotal trial. And then finally, you've got companies that have commercial products on the market where they're commercializing themselves. They are the marketer. And that would be a scenario for a classic synthetic royalty or royalty-backed loan. And when we get to it down below, we'll talk about it. Those can look more equity-like or more debt-like in terms of their structures. So with that, Todd, I'll hand it over to you to give a bit of an overview on royalty finance.
Great. Thanks, Ryan. Yeah, so just to take a step back and look at this from a broad perspective for some of you that aren't familiar with royalty finance. So what we're talking about here are royalties or revenue interests, right? So rights to royalties under a license agreement, or just in terms of synthetic royalties, revenue from future product sales where no license agreement is in place yet. So the term royalty finance broadly describes a sale or financing of royalties or revenue interests.
And Todd, how do you deal with like milestones?
So in terms of milestones, sometimes those are included in a royalty finance if there's a license agreement in place. Sometimes the sale of the royalty will include the sale of milestones. In a synthetic royalty, we'll also see, if certain milestones are hit, sometimes that will include, additional payments under that type of structure.
Got it. But if my license includes milestones and royalties, I could sort of pick and choose which I want to monetize.
Absolutely. Yeah, you can throw the whole basket in. You can just sell the royalty. You can throw a few milestones in plus the royalty. That's right. In terms of royalty finance, we like to point out that the history of this asset class draws inspiration from the iconic David Bowie. And I just like to, always get David Bowie in a presentation. So bear with me here. But yeah, the history draws back to Bowie bonds, which David Bowie issued in 1977. He was looking at selling his masters at that time. And at the time, Bowie was one of sort of a few artists that actually owned his masters, which wasn't very common. So he was looking at raising money and potentially selling his masters. And he and his attorneys came up with this innovative structure to issue Bowie bonds. So these were $1,000 denominated bonds that they issued and raised $55 million. They carried a coupon of 7.9% interest, maturing over 15 years. And these bonds were backed by his assets, basically his masters, his publishing catalog, and royalties streaming from a licensing deal he had with EMI, future album sales, and live performances. So moving on. So as Ryan introduced, there are typically 2 or 3 structures of royalty finance. We include clinical funding arrangements together with synthetics in this presentation. But so the main difference here is traditional royalty finance is a sale by a licensor of its rights to receive royalty payments under an existing license agreement. So the royalty stream is an existing asset, right? It's an existing right under that contract to receive those royalties. The synthetic royalty, there's no license agreement in place. So the question becomes what's being sold, which we'll dive into later. But this is basically a biotech, maybe at an earlier stage of development or commercialization, and they do not have a license agreement in place, and they're basically selling or financing a future stream of product sales.
So Todd, with the overview at the beginning about sort of capital markets environments, what are we seeing now in terms of the utilization of these, recently with the markets being tumultuous?
Yeah, so we just published a royalty report looking at royalty finance transactions and sort of key statistics over the last 5 years. These we looked at over 100 transactions in the space from the top most active funds in the space. And these are publicly announced, right? So we wouldn't see as many clinical funding arrangements in this survey just because those are done typically with larger pharmaceutical companies, and they're not necessarily material, so they may or may not be publicly announced. But some of the key trends we saw in this data was that there's definitely a rising use of synthetic royalties. We saw an average annual growth rate of 33% over the 5-year period. There was increased activity in more recent years, driven by high-value deals and late-stage product transactions. And we also saw an increasing use of milestone-heavy transactions, so using milestones as additional sort of payment thresholds to offset risk here.
And one thing that's interesting is the increase in the number of royalty finance providers in the space. That as this asset class has grown and as investors, institutional capital are seeking returns that are uncorrelated with overall market returns, there's been an increase of interest in this particular space in this asset class. So now when companies are going to market looking to monetize a royalty or do a synthetic royalty, you're seeing more companies bid on that than a decade ago. And
Yeah,
and as a result, the pricing is getting more competitive, which is in turn making it more attractive for companies looking to sell these royalties. So there's been sort of a virtuous cycle there in terms of how the markets become more efficient and more attractive, I think, for royalty finance providers as well as royalty sellers.
that's right, Ryan. We're seeing a lot more funds engaged in this asset class, and with that also, I think not only has the market become more efficient, but we're seeing a lot more hybrid deals, right? We're seeing royalty, traditional royalty finance transactions stacked on top of debt transactions, right? Just straight secured debt, and having those, both of those sort of facilities coming together in one transaction. We're also seeing a mixture of royalty finance with converts or equity and debt. And so it's interesting to see what, the range of transactions as we get more funds into this space.
Yeah. The Blackstone Alnylam $2 billion deal with a royalty purchase, equity, and debt is a notable example of that.
Exactly. So we have a few slides from our royalty report just showing some of the statistics and trends over the last 5 years. So this first one is looking at the number of transactions. And over in the chart, you have the sort of blue, which are traditional royalty finance transactions, and the orange, which are synthetics. So you saw sort of overall a leveling of the number of transactions through 2022, and then a big jump in 2023 and staying steady through 2024. But in particular, if you look at the orange chart, right, from 2022, you see a slight jump in 2023 and then a very large jump in 2024. That's the synthetic royalty transactions that we're seeing more focus on these days.
Yeah, and when we flip over to the next one, the dollar values, I think it's even more pronounced.
Yeah, so it's similar, right? So over on the right, you see the sort of aggregate value over the last 5 years, 24.6 billion aggregate. And this is just the transactions we looked at, with an average annual aggregate value of around almost 5 billion per year. And again, in the chart, the blue is traditional and the orange is synthetic. And again, right, we see this jump in 2023 with the synthetic royalty transactions value nearly doubling from 2023 to 2024, going from 1.33 billion to 2.5 billion. And then lastly, this is looking at sort of the average transaction size rather than the aggregate. And over the 5 years on the right-hand side there, you see the average transaction size was around $250 million with a big range, right? From the very, very low end of 1.2 million to 1.61 billion on the higher end. And yeah, similarly with the synthetics, you see the sort of jump in 2023 and continuing to increase in 2024.
And in all of this, it's worth noting there is a little bit of noise in the data. When you go back and look at the number of transactions, for example, for synthetics, 2020 to 23, there is still single digits. And so, any really big or really small transactions can skew these numbers in any one year. But the trend in terms
That's
of
right.
synthetics is definitely pronounced. It's interesting too. This is picking up in 2020. If we went back and we did a 10-year look back, I think you would see a pretty pronounced increase in all transactions of this type, as the royalty finance space generally has grown pretty dramatically over the past decade or beyond.
Oh yeah, if we had extended it prior to 2020, the growth from just 2018 to 2020 alone was huge. So yeah.
Definitely. So Todd's talked a bit about the sort of synthetics versus the traditional royalty monetization. So I'm just going to take a moment to talk about what they are, and then we'll flip back to Todd to talk about kind of drafting practices and kind of tips and tricks. So for the true royalty monetization, as Todd said, you've got an existing license in place and you have an entitlement under that license agreement to receive royalties or milestones, and then you're looking to sell some or all of that. The types of structures you can come up with are pretty flexible. You can sell the entirety of the whole thing. You could sell a portion of it, like 50% of the royalties. You could sell a portion of it up to a cap, 50% or 100% up until 100 million in total, at which point it flips back. The 50-50 that I just described would be called a sale of a strip. If you sell it up to a certain amount, like say 100 million, that would be what's called a capped sale, where the royalties go to the royalty buyer to a point and then they revert back to the seller. You could also agree to a cap that has some sharing once you hit the cap. That's called a cap and a tail. So it could be 100% of the royalties up to 100 million. And once you hit 100 million, it becomes 50-50 beyond that. And then finally, for the caps, it doesn't have to be necessarily an aggregate cap. It could be an annual cap. You could sell the first $50 million of royalties received in every year, and anything above that would continue to spill over to the seller. So that's an annually capped sale. And you could even combine an annually capped sale with an overall cap or a cap and a tail.
That's just what I was going to say, Ryan. People get creative with these and combine them in all different ways just to kind of play with their cost of capital, right?
Right. And the application of this will depend on the specific facts. And so, for example, if you've got something that's very early in the launch cycle, the buyers may be wary and discounting it. And so you might do like an annual cap where you're selling the first dollar in up to a certain amount, which is the surest piece of the strip. And they'll pay more for the piece that has greater certainty, and they'll be discounting the piece that's uncertain. And so you retain the upside if it turns out that the drug outperforms. Another instance where you might do something like a cap sale is, let's say that you've got a follow-on indication that's coming. So it's going to be getting bigger over time, and you think that it's going to turn into a larger opportunity, and you want to flip it back, and you want to be able to capture that upside for a second follow-on indication. So the structure of how you sell this is going to be determined on a case-by-case basis, depending on the specifics of the individual asset that you're monetizing. In terms of synthetic funding arrangements, the arrangements that are available will really depend on what the funding stage is. And so on this slide, you can see there are sort of 3 points in time: prior to the successful pivotal trial, the period after the successful trial and before FDA approval, and then the period after FDA approval. If you're in the period prior to a successful pivotal trial, it's going to be a clinical funding arrangement. Once you have the successful pivotal trial and the financing source is no longer taking development risk, but they are taking FDA approval risk, it's likely to be a loan. And that's not a royalty-backed loan. That's a regular full recourse loan that probably needs to be repaid quickly if FDA approval is delayed or denied. Once you have an FDA-approved product, then you're looking at a synthetic royalty or royalty-backed loan. And I say all of this in absolutes, but nothing, of course, is absolute. It is conceivable that you could do a synthetic royalty or a royalty-backed loan on a pre-approval asset, but I think most of the finance providers would want the asset to be de-risked, and that would definitely be a special situation. You can see at the bottom of the screen the names of some of the parties who are the repeat players in different pieces, the different pieces of this based on the time period. So it's a slightly different set of names for the clinical funding piece versus the approved product and synthetic piece. It's just a larger universe of people who will do the financing for the synthetics versus those that will also take the commercial risk and the R&D risk associated with clinical funding. So the two pieces we're talking about today are really going to be either end of the extreme here. We're not really going to be talking about loans in between.
And to your point, Ryan, these are generalizations. We've seen
Yeah.
synthetics done pre-approval, right? But typically there's a requirement to pay back the amount if approval's not received, which then it's a sort of loan at that early stage and then flips into a sale, right?
Yeah, that's a really, really good point, Todd. So, people like to benchmark and point to deals, and I've had it happen a couple of times where people say, hey, such and such transaction, for example, CTI Biopharma, they did a synthetic royalty on their drug Vonjo with DRI, and that was signed prior to approval. And people will say that's a pre-approval synthetic, and that's not quite right. As Todd just described, the pre-approval tranche was debt, and the
Yeah.
actual synthetic didn't fund until FDA approval. The same thing is true. We'll highlight it in a minute here for Sparrow Therapeutics and HCR. That was a pre-approval synthetic, but the upfront piece was just structured as straight debt that had to be repaid within, a few number of days on a CRL or, just a rejection by the FDA. So you really do have to sort of read the fine print. And if somebody says there was a pre-approval synthetic, that's possible. It's not the market standard, and it probably was structured as a loan for whatever piece was funded prior to approval.
Yep.
Yeah, no, it's a great point, Todd. Okay, so assuming that you're in the realm then of implementing some sort of synthetic royalty financing structure, they sort of come in a couple of flavors really that sort of live on a continuum, some of which can be more debt-like and some of which are more equity-like. And so the continuum here has some differences highlighted between debt-like structures and equity-like structures. So equity-like structures would have, for example, an uncapped return. So you put in $100 million as the royalty finance provider on a synthetic, and there's no cap on your return. If you have a return, say 2 times your money in, and then at that point you're paid off, it's probably the rest of it is going to look more debt-like in its structure, just because the risk return profile is skewing greater cap in terms of the return, which is going to then provide greater certainty in terms of the risk profile. The debt-like structures will have debt-like covenants, including covenants limiting the ability to incur additional debt. It's possible that you'll set up a special subsidiary, an SPV, where you'll move the assets down, and that entity is going to be granting a lien on all of the product assets. Even if it's non-recourse, it might just be limited to that subsidiary. And again, conversely, in an equity-like structure, like the BioCryst or Ladeo financing, the covenants are very, very light, and it's sort of none of these sort of more debt-like protections are in place. In terms of other economic terms, for the debt-like structures, there's usually some sort of floor under that. So there's an obligation for the company that's entering into this arrangement, selling the synthetic interest, to provide catch-up payments to ensure that the finance provider is getting some multiple of their capital back at various milestones along the way. It might be, for example, that by the 5th year, they have to have received enough payments in the form of royalties to get to 1 times their invested capital. And if there's a shortfall on that on the 5th anniversary, then there's essentially a balloon payment that's needed to true them up to get them back to that level. Conversely, in a more equity-like structure, there's none of that there. The royalty finance provider is just truly taking product level risk in terms of their entire return profile. And again, would normally enjoy all of the upside. That's sort of, the other side of the coin with that. At the
Yeah.
bottom, yeah, go ahead, Todd.
I was just going to jump in, Ryan. So these features, right, are on a continuum as our graphic shows here, right? So certain royalty finance will have certain, you know, maybe more debt-like features like a capped return, um, but then have equity-like features in terms of lighter covenants. And I think it's important to keep in mind, and Jeff Krause is going to be getting into this in part 3 of our series, that the way you structure your transaction, even if you're calling it a true sale, there's potential risks of it being recharacterized in a bankruptcy proceeding as debt. For example, if you have catch-up payments, right? If you have guaranteed payments, um, uh, those start to look more like just a coupon, for a debt transaction. Um,
And when you say risk, is the risk really borne by the party who's lending the money, or is it really a risk for the company that's selling the synthetic? I think it's really more of a risk for the financing party,
it,
right?
it- that's right. It's the risk for the financing party, and whether, but also whether they're guaranteeing payments. I think that's sort of a key factor going back to the company, and uh, and and so decreasing the risk of the financing party, exactly. So that if the funds guaranteeing payments for the seller or the financing party.
So the logos at the bottom here are not arrayed randomly. They are arrayed on the continuum that roughly aligns with the nature of those transactions. So Sparrow was very much a debt-like transaction on the left-hand side, and BioCryst on the right-hand side is very much an equity-like transaction. And then we'll talk about it later in the presentation. But La Jolla Pharmaceuticals is one that is, I think, squarely in the middle that has some equity-like features and also some debt-like protections on it. But just pivoting back for a second to a royalty monetization transaction for just an example of what sort of it looks like to help everybody understand. We're going to talk for a second about Xtandi. So Xtandi is a prostate cancer drug that was developed at the UCLA Medical Center in the 2000s. They outlicensed it to a startup company at the time called Medivation. Medivation commercialized the drug and then later was sold to Pfizer. The drug was approved in 2012. It subsequently has gone on to become really an important cornerstone of prostate cancer therapy. And it is definitively a blockbuster. The 2024 sales of Xtandi were reported to be $6 billion. So UCLA has the royalty that they're entitled to from Medivation, now Pfizer, and it turned out to be quite substantial. And they were interested in de-risking having all their eggs in one basket here in terms of a source of revenue coming into the company. And so they ran a process where they tried to find a buyer for it. They engaged Goldman as the financial advisor. We served as the legal advisor to UCLA. And through that process, they ultimately entered into a transaction with Royalty Pharma, who is one of the larger royalty finance providers in the space. Royalty Pharma bought the rights to almost all of the royalty entitlement from Medivation. Interestingly, the slice that they didn't buy was a portion really for the benefit of the inventors under the UCLA inventorship policy. The 8 faculty members who were co-inventors of the drug were also entitled to a portion of the royalty proceeds. And in their case, I think the inventors sold some or most, but not all, generally speaking, of what they were entitled to. So the total portion that was sold to Royalty Pharma was less than 100%. And then that was for $1.14 billion, which at the time was the largest academic monetization ever. So a fairly simple and traditional transaction for a royalty monetization. And in contrast, for a synthetic, as we said earlier, there is no current license agreement that's generating the income stream that's being sold. And instead, the company that is the inventor of the drug, the marketer of the drug, is the person who's selling a portion of the future revenue that they expect to receive from their own sweat equity selling the drug. Because the party selling the royalty interest tends to be a small to mid-cap biopharma company, the counterparty risk from the buyer's perspective is quite a lot higher than buying a royalty that's being paid by someone like a Pfizer or a Merck or a Novartis. The royalty finance providers are very comfortable with the counterparty risk of the global pharmaceutical companies, but they are going to have to look at the balance sheet and the capital structure of companies selling synthetics with a more careful eye towards what exactly is the downside, where you're relying on a smaller company that doesn't often have a lot of commercial experience or a large sales force that's going to be driving the revenue that's ultimately generating the royalties that will generate the return for the investor. So an example of a synthetic transaction that was more equity-like in terms of the structure and the return was one I referred to earlier. That was BioCryst's sale of a royalty on Orladeyo. This was a transaction from, I think, 2020. BioCryst sold a strip of the Orladeyo revenue. In the context of a synthetic, it's always a strip.
That's right.
One would never sell 100% of the royalty, creates a moral hazard for the seller to make no effort to sell. So it was a strip for 125 million. It was funded on FDA approval. It says NDA approval. That's the new drug application. So when the FDA approved the drug is when it was funded. So this was negotiated pre-approval, but it was not funded until approval. And it provided for an 8.75% that would sort of decline down over time royalty on Orladeyo sales. There is no cap. There are no catch-up payments. It is a true equity-like in terms of the financial interest that they got. And there was also a true sale opinion and an intercreditor agreement with Ethereum, who is the senior lender. On the other end of the spectrum, we have a much more debt-like transaction, which was, again, kind of on that continuum earlier. And that was Sparrow Therapeutics, which sold a 12% strip on tebipenem, which is an antibiotic. That was for 125 million. That was broken up between 50 million on close, 50 on approval, and 25 million commercial milestone. You may think that this violates what we said earlier about synthetics funding pre-approval, but that asterisk is an important footnote to be repaid if NDA approval is not achieved by the outside date. Here, in this case, Sparrow did receive a CRL, complete response letter from the FDA. They're currently running a new pivotal phase 3 trial, and they did have to repay the 50 million plus, I think it was 13% interest on that, roughly in a 1-year period. Had the royalty remained outstanding, had they gotten the product approved and it remained outstanding, it would have been a 12% strip, again, declining over time on Tebi sales worldwide. This was debt-like, so this had both a cap at 2.5x, but it also had catch-up payments along the way, so various balloon payments to make sure that HCR was getting brought up to an appropriate level and it was not getting too far behind. It also had various events of default and acceleration triggers relating to, sort of what happened with the company, what happened with the drug. Those were heavily, heavily negotiated. And then finally, for a sort of in between, I mentioned the La Jolla transaction earlier. So La Jolla had just launched their drug Giapreza, which is angiotensin 2. This is for patients with sepsis and hypotension. It was a $125 million purchase price. Again, it was early in the launch, limited sales history. The economics of it were pretty equity-like. So it had a 10% royalty. In this case, it was increasing, so it would step up from 10 to 14 to 18, depending on the pace of return of capital over time to HCR. It was capped at 1.8 times, which is attractive to La Jolla, but importantly, it didn't have any floor on it. So there were no catch-up payments. There was no true-up payments or balloon or maturity payment. So this was equity-like risk on the downside and debt-like returns on the upside, which from La Jolla's perspective is sort of the best of all worlds. It did have very much debt-like protections in place in terms of covenants and an SPV structure and everything else. So it was a heavily structured transaction in terms of the protections in place for HCR. But it was an attractive structure, I think, in terms of the economics for La Jolla.
Yeah, this was an interesting structure and really sits in that sort of hybrid between debt and equity transactions, right? And the step up in royalty rate, I think, as an alternative to catch-up payments, if you're interested in
Yeah,
a true sales structure as opposed to a debt structure, is one way to handle that, right?
absolutely.
Yeah.
All right, back to you, Todd.
Thanks, Ryan. So we're going to close out here looking at some drafting considerations in the context of synthetic royalty transactions and what folks should be focused on and looking at. What's key in synthetics is the scope of collateral, right? Because as Ryan mentioned earlier, the risk profile has shifted for the funds, for the investors or the buyers, right? Because the payer in a synthetic is the biotech, the company, whereas the payer in a traditional royalty finance transaction is the big pharma. It's the licensee. There's much less risk under that scenario. So with that risk, if there is a downside scenario and the company does go into bankruptcy, without some type of attachment to the underlying assets in terms of liens, the IP could be sold. And basically what the investor fund would be left with is just an unsecured contract claim in that scenario. So in a true sales style transaction, we would typically advise the funds or the investors to have a backup security interest in case the transaction is recharacterized as a debt transaction and the sale is not honored. A backup security interest in not only the royalty stream or the royalty payments that were acquired, but also the product-related assets. So those would typically include the IP that's relevant to the products, the regulatory materials, including the approvals, and any key license agreements. So this would be typically if there's an in-license at the time or any future out-licenses that are entered into during the term of the synthetic. In terms of reps and warranties and covenants in a synthetic, as there's a little more risk involved here, for the funds and investors, there's more extensive reps and warranties, and these tend to focus on the intellectual property, as that is really what is underlying the future revenue stream, right? And the strength of the future revenue stream. So not only the patents, but also the know-how, and then there's also a focus on the compliance with manufacturing and also the regulatory assets as well in terms of reps. For covenants, we also, obviously, the maintenance of intellectual property is key here, as well as defense and enforcement. So there's a strong focus on that in terms of the covenants, but also information sharing, right? Because you want to be, from a fund or investor perspective, they would want to be made aware of any material developments, and have notices provided of such developments.
The other key covenant is going to be the commercially reasonable efforts, or CRE, standard for commercialization.
Uh,
And well, there's an interesting dynamic at work, which is for the fund who provides the capital. Let's say you sold a 10% strip on your drug. They're getting 10% of the top line number. And they don't care how much it costs to drive an extra dollar of top line revenue. So if it costs you $2 to generate an extra dollar of revenue, that's a good trade for the fund because they're getting 10 cents of that extra dollar. It doesn't matter to them necessarily that it's costing you $2 to do that. So working out what exactly the level of performance is that's required is really important. And I think the market has shifted over time from a more general, commercially reasonable effort standard to one that sort of puts a floor in place that says, but in any event, in line with the commercialization plan you have intact today, right? Whether you're just launching or you've had something in place, that's going to be, a minimum number of FTEs, sales reps, countries that you're covering, that kind of thing. But that is going to be something that's very much in play and in negotiation in these transactions.
Ryan mentioned, use commercially reasonable efforts to, develop the drug, and yes, we see we're seeing more and more sort of minimum efforts in terms of, well, what is the size of the sales force, and also, balancing resources for the product that's in the synthetic vis-a-vis other products that the company might be developing, as well as how those are sort of given priority in the manufacturing process, right? So in terms of how companies want to, will structure a transaction, there's quite a lot of considerations. Tax considerations are always paramount, and obviously there's different tax implications if you're structuring it as debt or a sale. Also, the product itself and the marketplace and the risk profile and the modeling of the return, those would all go into whether this is debt or styled as sale. And depending on the structure that you choose, there's going to be a different sort of, as we've mentioned, a different level sort of focus in terms of covenants and guarantees on return, and how the liens and the security interests are structured as well are going to change.
In addition to the tax considerations, it's also important to wrap your arms around the accounting considerations just to make sure that you understand going in exactly how it's going to be accounted for on the balance sheet.
Exactly. So looking at, true sales of synthetics, which have grown in popularity in recent years. Again, since there's no currently existing contractual right to a royalty stream, questions have surfaced in the industry. So what is the asset that's actually being sold here? And if we dig into that, what's being sold are future product sales, right? Revenue from future product sales. And so touching a little bit on what our colleagues are going to be presenting on in the second and third panels of the series, under the UCC, the UCC defines basically an account as a right to payment of a monetary obligation for property that has been or is to be sold. So, future product sales fall squarely into that definition of an account under the UCC. And in terms of what is being sold then, so we're looking at a sale of accounts, right? And an account means a right to payment of a monetary obligation for property that is to be sold. And the UCC recognizes that in terms of an asset that can be sold and is protected in terms of the UCC regime. And on that note, typically you would want to file a UCC1, right, declaring to the world that this future revenue stream has been sold. And in our third panel, Jeff Krause is going to be focusing on risks of recharacterization here, right, which we alluded to earlier. So even if you do structure this as a true sale, and the intent of the parties are that it's a sale and it's written into the contract that this is a sale, there's always a risk of recharacterization, depending where you're at on that continuum, right? If you're far on the right of the equity-like style transaction that's uncapped, no minimum payment guarantees, the risk of recharacterization is very low. But once you start having minimum, especially minimum payment guarantees, the risk becomes very high that that's going to be recharacterized as a loan, even if you style it as a true sale. So Jeff will get into more nuances there in terms of bankruptcy analysis and what goes into all the characteristics and the features that would drive recharacterization from a sale to a loan.
So I think we're nearly at time. Allison, do you have questions for us where we can clarify anything?
I do. I've got a few questions. But first, I just want to say how informative this presentation was. I said it at the top that you guys are the experts. You are the experts. I think that was very clear throughout the presentation today. And so I think we're really lucky to get to benefit from your expertise and your insights here. So I've got a few questions to probe at some of what we've talked about. But I encourage our watchers to reach out to Ryan and Todd if you have questions. I guess I didn't ask you about it in advance, but I assume you're very open to those types of inquiries.
Of course.
From interested viewers. So their contact information will be available as part of the program. So I'm going to take us almost back to the beginning at this point and really thinking about the big picture here. So got really volatile biotech markets over the last few years, and you guys have been living that. Your statistics really clearly paint that we're seeing a growing popularity in royalty financing. I'd love to probe a little bit more about, exactly what you think's driving that. And I think maybe even more than that, what are the most strategic uses that you're seeing? I think a number of portions of your presentation touched on this, but I think it might be useful for our viewers to really kind of tie all that together.
So one strategic use is that's kind of a common fact pattern is a company is looking to fund for the commercial launch. In particular, you don't know whether the company is maybe going to be sold on FDA approval. And so the market value isn't pricing in success with the FDA or even your phase 3 readout. The market might be expecting there's sort of a financing overhang out there. And so it's sort of keeping a lid on the stock price. And moreover, if you're going to get approved and then maybe sell the company, then there could be, you don't want to give up the additional dilution and upside on the equity that you otherwise would be getting with the sale to large pharma on the back end. And so kind of a classic fact pattern would be doing a royalty finance, a synthetic, around and leading up to your FDA approval. And the story to the street is we're doing this to fund launch and we're fully funded. We're not going to raise equity. It sends a strong message to potential buyers in the M&A transaction. It eliminates the financing overhang and lets the stock rip on positive news like FDA approval. The issue there is, have you created your own overhang with a buyer by burdening the company with a royalty? And that's where you have to think about things like Is there a cap? Is there a change of control premium? Sometimes it's tiered, like if the change of control happens in the first 12 or 18 months, it's a minimum premium, which is kind of your transaction window, and then it steps up after that. But that's a common use case, and there's a lot of variables and sort of levers that we can pull to make the facility fit within a company's objectives. But I would say that's a very a sort of classic use case.
Yeah, that's right. And just to add to that, from the, investors, from the investor side, these this asset class is not correlated with the capital markets, right? So when we see fluctuations in the capital markets, these product level investments, um, you know, aren't necessarily impacted in the same way as the capital markets are. From the company side, as Ryan alluded to, this is another way to raise capital that's not dilutive, right? So if you're not looking to dilute your equity, um, this is an attractive option, and it's also not as burdensome as a loan, right? You don't have the same level of covenants
Sure.
as a loan, the same risk in terms of, hitting those coupons as a loan. So it's sort of an attractive in between of equity and debt for the company.
I'm going to go off script with this question. So, yeah, I think you both made comments earlier in the presentation about royalty financing becoming a more competitive option. The pricing is becoming more competitive. Do you view this type of financing as something that needs to be competitive with its alternatives in order to be most effective? And if so, how do we get it there? Are there structural changes that need to happen, or is this just a matter of people just need to get more comfortable with the idea that this is an option and that it works well in a number of scenarios?
I think we're just seeing it become more competitive with the increase of funds in the space. And because of that, when a company's um, engaging in an auction process and asking potential buyers or investors to bid on a royalty stream, what we're seeing now is pricing, I think, that's not so all over the place, and that the level and of diligence has increased, the level of sophistication has increased, and so we're just starting to see pricing that is a bit more rational in the space, and I think that's good for everyone, right? It just makes the asset class that much more rational.
The other thing you see, Allison, is, for processes that, Cowen or others who are sort of frequent flyers in the space run on the sell side, they'll go out and solicit everyone and bring them in and try to make it as competitive a process as you can. That's great if you're a seller. If you're a buyer, you're going to be bidding on a lot of assets and not winning. And so it puts a premium on proprietary deals.
Hmm.
So the buyers will frequently go out and try to source their own deals apart
Mhm.
from, sort of the Cowen-led processes out there. It also has been part of what's driving a willingness to do earlier stage deals. So if you look, for example, at Royalty Pharma's purchase of the royalty, it was a true monetization from Arrowhead on the basis of phase 2 data. And that was a big check size up front with no strings attached. And they have real conviction around that asset that Arrowhead's partnered with Amgen. But the competition for these go to market deals is sort of forcing people to spread out and to go earlier in the pipeline, which again, as Todd says, I think is a positive thing for the industry.
That's incredibly helpful. Without violating client confidentiality, and I think some of the examples you might want to point to may not even be your clients, although some of them probably are there any particularly innovative or complex structures that you think would be useful? I thought your examples were really helpful in terms of thinking about how these sorts of arrangements work, but I'm curious if there's any other structures that you think would be useful for the audience to learn a little bit about.
So I think all of the deals we've talked about are publicly disclosed and on Edgar. So for those who are interested in chasing them down, they are. Um, I will say that Zoma, which is a royalty aggregator, it's a public company that goes and they buy royalties. They are the most creative in terms of coming up with interesting structures, whole co-acquisitions, and just really creative, interesting stuff. So if you're looking for creative solutions and it's out of the box, Zoma is, I think, the player on the buy side who probably has sort of the most creativity there. Um, I would say, for sort of just a more traditional, synthetic or royalty monetization, I don't know. I think all the players in the space will entertain, whatever a seller wants to put forward in terms of kind of economic terms, uh, you know, bundles of royalties in a basket, kind of interesting, funky caps and tiers and things like that. But that's just sort of playing around with the economics. Zoma will actually like go totally out of the box in terms of thinking about structure and will put forward proposals that are really quite novel.
That's right. And touching on your point earlier, Ryan, I think Zoma is one of the buyers that has started to focus on or has been focusing on earlier stage assets, right?
Sure.
And hitting that end of the market. And yeah, and just to echo what Ryan said, I think the use of milestones as a payment structure has emerged quite a bit, especially more in recent years, to sort of play with that risk profile in a way that makes sense for both parties involved. But that again, that's just economic shifting. In terms of risk shifting on the sort of legal side, um, what what we've seen in synthetics in is the use of SPVs, right? Special purpose vehicles. If there is a bankruptcy risk, just dropping the assets into an SPV, making that SPV bankruptcy remote from the parent is a way to deal with the increased risk in a synthetic.
And one more, Allison, that comes to mind was Royalty Pharma's acquisition of Immunext, which was a whole co-acquisition for a royalty, and that was really done for tax efficiency.
Mm.
So, there was a willingness there on their part for the company to spin off everything that was non-royalty, leave the royalty in the box, and then Royalty Pharma bought the entire box in order to optimize the tax outcomes for the inventors who owned the entity that held the license. So back to what I said earlier, I mean, I do think the large players like Royalty Pharma, they can be very creative. They will work with counterparties to try to, come up with good solutions that are win-win. I mean, it's a very constructive space. I think the goal for win-win solutions is very, very strong.
Think we've got time for one more question. And I think this ties back to a portion of the discussion that you were leading, Ryan. A really helpful slide and discussion that you had about the various different types of financing. Pinged the question for me, who's the right candidate for each type of financing? You've touched on that throughout the presentation, but I really wanted to give the opportunity to kind of bring it all together. Who's the right candidate, and then what are the risks and the features that arise?
Yeah, so if you've got a royalty-bearing license where you're receiving royalties or milestones, you're a candidate for a royalty monetization. And that's one of those little four graphs of a cap or a cap or tail. Like, some version of that may make sense for you. If you have a clinical stage asset that's not approved, you may be a candidate for a clinical funding arrangement. And that would be, some sort of funding in exchange for a synthetic return that could be royalty and or milestone based on the back end. But that's probably going to be a late stage clinical program. You're likely funding a pivotal trial. And then finally, the last one is if you have a commercial product and you're the marketer, then you are a candidate for a synthetic royalty. And that would be, the type that Todd was talking about, where you're selling a strip of your future royalties from the product that you're selling with your own sweat equity. And that's the one that lives on the continuum between equity-like and debt-like. And that's where, going to market and seeing what you can do and drive in terms of deal terms would really be, necessary to find out what the art of the possible is.
That's right. I would just add to that, in terms of that last category, if you're commercial stage or near commercial stage, right?
Sure.
Yeah.
I want to thank you two so much for doing a wonderful job with this presentation. I learned a lot. I know our viewers will have learned a lot. If you were a viewer and you have not yet registered to view our synthetic royalty in the UCC and synthetic royalty financing, recharacterizing a true sale programs, time to go over and register for those. So we look forward to seeing you there. Thanks so much and have a great rest of your day.
Thanks, Allison.
Thanks, everyone.